Hi, class. Welcome to Chapter 14, where we discuss financial statement analysis. Financial statement analysis is a huge topic. If anyone here ever decides to pursue their CFA charter, which is an advanced certification that will hopefully lead to a successful career for folks, a huge part of it is looking at the financial statements. So difference between financial statement analysis and perhaps being an accountant or something along those lines is that the financial statement analysis looks at the accounting statements and then makes judgments based on those statements, which is the key distinction between that. So this is a great chapter. It's very heavy in terms of content, but I think you guys will get a lot out of this. This is the last chapter we'll cover for this semester in the winter of 2020. So please feel free to ask me any questions. You guys can always reach out to me as well if you need any career advice, job reference, anything like that where I can be of help. I'm happy to. Do not hesitate to reach out. If you're not already connected with me on LinkedIn, I would please encourage you to try to find me and add me. Otherwise, let's get started with Chapter 14. So major financial statements include the income statement that shows the firm's revenues and expenses during a specified period. The balance sheet, that's the accounting statement of a firm's financial position specified at a specified time. Financial statement, then there's the cash flow statement, which is this financial statement showing the firm's cash flow and receipts and payments over a specified time. The differences between these three, the income statement and the cash flow statement show earnings over a period of time, whether it's income or cash, while the balance sheet is a point in time. This is an example of an income statement. What's the most important thing in the income statement is usually the net numbers, right? What is the total number of net income? Net income is, here is 13%. Right, their net profit. So that's obviously good to see, and you want to see those profits growing. You also see here in the income statement that out of the $10,000 or so in earnings, earnings or net income, they put about 20% aside to pay out to dividends for investors. Next, we have the balance sheet. The balance sheet shows all the assets, liabilities, and owner's equity for a firm. You can see they normalize some of these numbers here on the percentages. So we see that cash is 5%, while inventories is about 30% of assets. So, and you can also see that they have receivables of 3%. That's about 10% of their inventories is given away on credit via receivables. We can see their fixed assets if they own a lot of property or machinery or equipment, and then we can see their liabilities. So looking at all these things in aggregate is really important. One measure you can look at for people who are familiar with accounting is look at current assets over current liabilities. We see that current assets are greater than current liabilities, meaning there's little risk of near-term bankruptcy for this company. Home Depot's statement of cash flows, this is just showing the actual money coming in and money coming out in a few different categories. One category being their actual operations, their investments, and then financing activity. Financing activity is almost always negative from a cash flow perspective. It's the payment of interest or debt. Investments, if you buy or sell equipment, if you buy and sell property within your organization, that will be an investment cash flow. So if you're McDonald's and you sell some property, that's an investment cash flow. Your operating cash flow is the money, the dollars that come in the door from burgers and fries, right? How do you measure performance? There's a whole bunch of ways that you measure performance. What does good look like? What drives shareholder value? What makes assets efficient? What makes, how do you increase profitability? If you're profitable, some profitable firms use leverage. They take on debt because that can magnify the returns. And then liquidity. If you have an automobile dealership in the middle of the 2008 recession, you might find that there's less people to sell cars to. And because your inventory is tied up, it's not liquid. What is profitability of investments in real assets? So it's actually, if you look at profitability, it can be comprised of return on assets, return on equity, and return on capital. What's the economic value added? Also, what would be considered, an asset effectiveness ratio would be turnover ratios. So how many times does an organization flip their inventory in a given year? And then how profitable is that inventory? So if you can increase your profits and flip your inventory faster, meaning selling your goods faster, that should lead to an overall healthier firm. What else is concerning? Debt ratios. Debt ratios is how much you're worth versus how much you owe. And then coverage ratio is more like, can you cover the minimum monthly payment or the minimum annual debt payment? Is there sufficient liquidity? So again, current ratio, which we looked at on the last slide, also other cash ratios or net working capital. Return on assets is earnings before interest and taxes divided by total assets. Return on capital is EBIT divided by long-term capital. Return on equity is the income or the net income profits divided by the shareholders' equity, what is owned and what has been contributed into the firm. And then there's leverage. Basically, what leverage does is it enhances the return on your investment. Leverage can also act as a tax shield because you get a tax deduction on debt. That's effectively what this formula is showing us here. If times are good and you have leverage, it's amazing. But if times are tough and you have a lot of debt, things are bad. So this is just showing an example how an analyst might model a three-stage scenario. Like, what does it look like in a good year, normal, or a bad year? And how would that change their numbers? So the analyst is making some kind of estimate based on what they think would be prudent. And then the impact of leverage, right, on ROE. ROE, with the same amount of profit, leverage will enhance that profit to a very high degree. And in a bad year, it makes it worse. So we can see the good year with leverage, it's a great year, right? Economic value added. Measure of dollar value of firms' returns in excess of opportunity cost. What is opportunity cost? Opportunity cost is the cost of your next best idea. What could you do alternatively? Or opportunity cost is maybe what your risk-free alternative is. Like, you could invest in this new factory or put the money in the bank, and get 1%, This is also known as residual income. The spread between return on assets and cost of capital is multiplied by capital invested in the firm. Spread between ROA and the cost of capital multiplied by capital investment in the firm is also valid. Next, this is talking about economic value added for a variety of firms. How much value do they add? We think about with the power of Microsoft, with the work they get done for people and the cost to kind of transmit all these spreadsheets and information. They're saying that Microsoft adds a lot of value for its investors. Decomposition, and some of this is based on when this was done. So it's saying a lot of this ROE stuff was done back in 2016. The real estate market hadn't rebounded as robustly as it has now. You might see a company like Home Depot here with even better numbers given what's happened in recent years. Decomposition of ROE, you can break the return down into several components, right? And this is a 5-stage, which it's called a 5-stage DuPont analysis. So it's net profit divided by pre-tax profit divided by EBIT divided by sales divided by assets, and sales divided by assets is actually your sales turnover. It's a sales turnover number. And then assets over equity, right? And assets over equity is what? Leverage, right? How much you have versus how much you own. So that's a measure of leverage. So that last measure there would be, effectively how you measure how much debt they're using. So total asset turnover, that's annual sales generated for each asset. Then you have the interest coverage ratio, which is financial leverage. We already talked about that. The leverage ratio, and that's the measure of the debt to total capitalization of the firm. And then the ROE is the tax burden minus the interest burden minus the multiplied by the margin, multiplied by turnover, multiplied by leverage. This is effectively that same formula we saw, but in words. Next, median ROA, profit margin and asset turnover for 23 industries. So just showing some profitable than others. You'll often see that what has high profit margins. Utilities, amusement parks, health services, lumber, paper, printing, personal services, and what's very low margin, grocery stores, wholesalers, right? They're going to be doing a lot of big volume business. Ratio decomposition for a variety of firms. So they're actually, instead of modeling one aggregate number, like what if profits are 20%? They get to say, all right, what if profits are higher, but they increase leverage or decrease leverage? What is taking on more debt going into a bad year look like? What is taking on, so that's why you see a lot of companies right now paying down debt, because they're worried about maybe what if next year is a bad year. They don't want to walk into that environment with a lot of debt. Next, this is looking at differences between profit margin and asset turnover across industries. And I'm just going to just pause this really quick here, guys, and I'll edit this out. So I'm going to step away for one quick second. All right, what this is showing here is the profit margin and asset turnover for selected industries. So we see low profit margin at the supermarket, but they have a high turnover, meaning they're selling a lot of stuff. And then at the utility company, they're selling, not turning over their inventory a lot, whether that's coal or whatever they're using as resources inventory, but their margins are very high, right? At the end of the day, they have the same or similar return on asset profile. Next, fixed asset turnover. How efficient, how much sales are you getting out of your fixed assets? And fixed assets tend to be properties, equipment, things like that, manufacturing hubs. So how good are you? How much can you generate out of your manufacturing hub? Next, industry turnover or inventory turnover ratio. That's a misspelling. That's the cost of goods sold by the average inventory. And then average collection period, accounts receivable per dollar of daily sales. Some liquidity ratios is the ability to convert assets into cash. So the current ratio is all your current assets, which includes inventory, over what's owed this year, which is your current liabilities. The quick ratio is almost identical to the current ratio, with the exception that the current ratio includes inventories The quick ratio is more conservative as it excludes inventories. It assumes the inventories are not sold from a bankruptcy perspective. And then there's cash ratio. What do you have in cash against what you owe? This is Growth Industries financial statements, and what it's showing here is that you see a business that has sales that continue to grow. So sales are growing by about 20% a year here, and then profits. Actually, even while what was interesting here is that while revenue grew, net income shrank. So what was the big thing here is that you see as the revenues went up, our cost of goods sold went even higher than our cost, than our revenue. So that ended up being less profitable. So that's an issue with growth companies as they try to acquire new customers. Next, market price ratio. You have the market to book value ratio. Market price of a share divided by its book value per share. Book value ratios are very common when valuing home builders. Price to earnings ratio, that's the most common valuation metric. You have their earnings, which is at the bottom, and then you have the price, which is at the top. The price is their current price. So you look at the market price over their earnings, and that the earnings number, there's two PE ratios. One of the PE ratios is price to earnings based on the last 12 months, which is accurate. But the other price to earnings measure is based on what are the earnings expected to be for the next year, which should make the number more reasonable, but it also uses estimates. So whenever you have these equations and these ratios, you always have to question what the estimates are, what the numbers are using. And this is just a continuing of a summary of all these ratios and their associated formulas. While I don't use these every single day, they are fairly relevant to my work. And this is showing how these ratios change over time for Home Depot. You can notice here that the profit margin and the turnover decreased significantly, as did the return on assets for a company like Home Depot during the Great Recession, 2007, 2008. This is showing really good reference chart, actually. What are the average metrics for each different business? Because these metrics are not uniform. It's more common for clothing companies to have a higher current ratio. And why is their quick ratio so much lower? Well, the clothing companies keep a lot of inventory on hand. So their current ratio and quick ratio are going to be really, really large difference. Meanwhile, like printing and publishing, they don't carry hardly any inventory, so the current and quick ratio are virtually identical. Growth industries, so we see that sales and operating increased by 20%, but return on assets, return on equity was declining, return on assets did not, and that was just a rapid increase in year-to-year short-term debt, and interest expense was another issue. So what happens there? Right? And we see the profit margin shrinking. We saw that. Why was that occurring? That's because the cost of doing business for this high growth firm was very high. When you have a high growth firm, it's not uncommon to see them spend a lot on expenses. This is just continuing to look at the cash flows of this business. So we see here that net income plus depreciation plus the accounts receivable, that's a decrease. So what's happened with the accounts receivable? We're generating a lot of these sales, by basically giving them away on credit, right? So a third of our sales are on credit. That's good if we get paid back, but can be concerning. And we also see that this growth company is making big investments in the plant, property, and equipment, while cash flow from operations is shrinking. But why is it shrinking? Cash flow from operation is shrinking because we're effectively loaning out all of our inventory on credit and not collecting for it. How do you measure for inventory? In the US, you can use either method, LIFO or FIFO, but in the international market, you can only use FIFO. Depreciation, when an asset, you buy an airplane and you're a jet company, what happens? You don't buy that asset in one accounting period. The cost of that jet are spread over the life of that asset. So you might see the cost of a jet, instead of the jet's $1 million, you might see the cost of that jet be $100,000 a year on their financial statement. And why do you do that? Is because if you just use that jet as a one-time expense in the first year when you buy the jet, you'll look extremely not profitable. But then in the 9 years following, you don't have that cost anymore because you hit it in a one-time charge, and then you look extremely profitable in the later years. So a lot of this is tied to accounting. Fair value of accounting. Most assets on a balance sheet are held at historical cost, not at today's market value. On the accounting side, they do not reflate the assets. So if you have a company that maybe like McDonald's bought its assets like 50 years ago, it's going to be worth way more than what it says on its balance sheet because the assets it's purchased are held at cost. Quality of earnings. So how sustainable are they? Do you believe that they're going to continue on in the future, or do you think that they're going to be at risk? One stock that I've recently invested in is a boating company called Brunswick. And why I believe in the investment is because I believe that they continue to grow from here, where the market might only believe the boat sales were a one-time pop. Here are some things you might look at: quality of earnings, bad debt, kind of surprise spending, earnings smoothing, revenue recognition, and then off-balance sheet assets and liabilities. Sometimes, if I sign a 10-year lease, that means I have 10 years of payments. But sometimes they'll try to hide those 10 years of payments as a rent expense, so you don't see it as a 10-year contract. You see it as like a one-time monthly. As I mentioned with inventories, sometimes they're handled differently. Is your oldest inventory sold first? That's the cheapest. Or is your newest inventory sold first? That's the most expensive. So checking out firms and how they handle their accounting statements, checking the notes in the accounting statements will add value and just something to be aware of. IFRS is the International Accounting Standard. If you ever choose to do the CFA exam, this will pop up there. And then lastly, this is just showing the differences in PE ratios versus adjusted versus reported in terms of expectations. But that's it for this chapter. It was really a pleasure working with you guys. Really enjoyed the semester as best we could virtually. And again, please feel free to stay in touch.